Hey everyone, happy Thursday, February 2nd. This is Markets and Mayhem here, and I have a special presentation. A wake-up call in 6 charts. I also have a special announcement, a new project that I've started with my partner Aisha called MacroVisor.com, where we focus on the big picture, or the macro, drilling all the way down into the micro, or the finite details, providing exclusive in-depth research. Sign up today by visiting our website for free and get our research delivered right into your inbox. Leading economic indicators are falling fast. Since the 1960s, negative readings lasting more than 6 months have always led to a recession, and it's quite likely that this time won't be different. This composite of 10 leading economic indicators looks at data that comes out that tends to lead GDP. So when you have 10 data points that are in aggregate moving into negative territory over half a year or longer, it's very likely it's going to lead GDP lower, which makes sense. And we can already see this in the GDP data. Whereas when the fourth quarter inventory build, a rise in non-defense spending by the government, and a fall in imports that was greater than the fall in exports all led to a positive GDP, with the consumer only accounting for 0.2% out of the 2.9% total, or well less than 10% when the consumer, during a healthy economic expansion, typically accounts for 2/3 or 67% or higher. So that's not a great sign. But let's drill down into the data just a little bit more and look at some other charts, because if we just look at the top level, we may miss some of the details, and that might cause us to not see some of the potential opportunities to de-risk or even take advantage of what may be downside to come. The next chart I have is ISM Services is receding. This is a leading economic indicator indeed, and it's in contraction territory, typically leading GDP growth lower when it is. As we can see on the chart, every time ISM has fallen, it's led GDP lower. The ISM non-manufacturing index is a services index. Services are the biggest part of the U.S. economy, and we're seeing signs that services businesses are experiencing significant declines. This is likely to lead to further economic slowing and more difficult business conditions, something we got a little bit about during earnings tonight from Apple or Amazon or Google or Qualcomm or even Ford. Even though Ford's a manufacturer of things, in this case vehicles, they're still a part of the economy, showing us indeed that growth is slowing. Similar with Qualcomm. They make semiconductors. The semiconductors go into electronics. But we can see in the next chart here the new orders are falling as well, and in fact quite a bit more than services, leading services lower. And that's a big deal because, this does count things like everything that we're buying out there in a tangible form or a product. And that's a problem because when new orders fall, it does lead the economy reliably lower. I don't think we're likely to see a soft landing. I would be quite frankly surprised with the kind of data we're getting in. Now, I'd like to see a soft landing. Don't get me wrong. I live here too. I want to see people do well. I want to see families not have to suffer. I want to see people who are retiring not have to sweat about their nest egg. But at the same time, it would be remiss of me not to mention these concerns, because these are real indicators showing real problems. The market might not be pricing them in, but perhaps that's because we haven't seen enough of it in earnings yet, and maybe what we saw tonight will be part of a wake-up call, maybe not. But I do think it's important to heed the warning signals that they're sending. Inventories have also been rising as sales have slowed. That's another sign that products are not being bought. So new orders are falling because inventories are full because products are not selling. And in an economy that's 2/3 driven by consumers, when 2/3 of consumers are living paycheck to paycheck and 40% are having trouble paying their bills, that does lead us down a rather unpleasant path for what that economy is going to look like in the quarters ahead. So let's drill down a little bit underneath the surface here and some of the things that people tend to buy. Cars are about 3% of the economy, cars, trucks, SUVs, all that fun stuff. We can see domestic auto sales in blue, foreign auto sales in green, both falling below levels that we saw during the great financial crisis. So consumers are in big trouble, especially when we see that car loan delinquencies are on the rise and have exceeded levels we saw during the great financial crisis. This is more evidence that the consumer is struggling, that so many households simply do not have enough money to make payments back on their debt. Now, these delinquency levels are rising in other areas like credit cards as well, and I think it just sort of tells a story here of folks who have not seen their wages grown commensurate with productivity or inflation, that's begun to catch up, especially now in this era of, yes, wages are rising in nominal terms and occasionally in real terms, but not enough to catch up with the aggregate price gains that have happened over the last 2 years and really over the last 30 years. So many continue to struggle. And I think this chart is giving us a little more evidence of that. But worse yet, home sales are down, and they're down significantly. As we can see here, the green line, existing home sales, the blue line, privately owned homes, or, these are the new homes that are being built by construction companies, by home builders, and they're not really selling well on either node. Right? The existing home sales have collapsed to levels that we haven't seen since the COVID crash, and before that, really right after the great financial crisis. And new homes took out the COVID crash lows and are just rebounding modestly, but are incredibly weak. Why does this matter? Well, real estate's about 15 to 18% of US GDP. Autos, of course, are 3%. We know the consumer's the majority, and we can see why the consumption side of GDP is so soft, because some of these core parts, these drivers of economic growth, they're falling rather than growing. And that's a problem for an economy that relies on an abundance of capital flowing through the system at cheap rates to provide this sort of appetite for debt-driven consumption, because a car is a debt-driven consumable, as is a home, as are many other things. Unfortunately, now people are taking on more and more debt on their credit card to pay their electric bill, their gas bill, for their groceries, for their rent, for all other manner of essentials. And that's telling us that people are spread thin, especially as their savings rates are falling at the same time. And home builders seem to be defying gravity, which is really interesting. Look at this chart. In blue, we have the National Association of Home Builders. And then in green, we have the Homebuilders ETF. Now, the National Association of Home Builders, we're looking specifically at the traffic of prospective buyers, but all of these other indices look just the same. And the NAHB indices, they are a composite of different measures of home sales and, foot traffic, as we can see, other indicators that tend to be leading for the sector. And we can see that foot traffic has fallen off a cliff, and what that's telling us is that people just aren't looking for homes. So we see home sales falling, we see foot traffic falling, and yet we see home builders continuing to ignore reality as they appear to be more correlated with rates as they've been falling and stable than the actual fundamentals, not even the economic data. I mean, obviously that matters too, but it passes through directly to them. So it's their fundamental drivers are collapsing. KB Home was a great example of that, with their net orders year over year down 80%. How can we look at this sector and say that it's able to continue to defy gravity? Either there's a renaissance in the housing sector where somehow the cost of owning a home more than doubling since the beginning of COVID doesn't matter, and people that have been locked out of the housing market for a very long time, primarily millennials, and their home buying prime age, they can't participate. So either we somehow magically get them back in the market, which I find to be very irresponsibly low probability. I mean, I just don't see it happening, and it's sad because I want to see everyone succeed. I want to see everyone of every age group doing well, but look at what's happening out there. This is a housing market that's priced out an entire generation during the time of their life where they should be getting a home to realize the American dream. And we're not seeing that. And it's heartbreaking, quite frankly. But I think that it will eventually catch up to the home builders. I don't believe they can defy gravity forever. I believe eventually, as this data continues to be problematic in the housing sector, that more and more we'll see some weakness start to pass through to the earnings of these companies, but also to the positioning, because you can only ignore fundamentals for so long. I still think that we are in a challenging market and economic environment, And if we look at some of the drivers of this rally, it's more retail participation than we've ever seen before. And no disrespect meant for retail. I'm retail too. But here's the thing. When everyone's piled into one side of the boat, this case being the long side, it's going to start to topple over. And that kind of looks like where we are today, with all the zero DTE options by institutions and individuals, with the incredible inflows into stocks. This is kind of dangerous. And I know we got to hear a lot of very encouraging things from Powell yesterday, in the sense that he sounded a lot more dovish than he had before. It doesn't mean he was dovish overall. He was still hawkish, but cautiously, timidly hawkish, and visibly shaken. And he said things like, financial conditions have loosened, but not, only a little bit since December, and we don't pay much attention to that. When the reality is they've loosened to levels by many measures we haven't seen since February of 2022, and fully discounted any intervention by the Fed. Now, obviously, financial conditions are large aggregated indices. The Chicago index has over 100 items it looks at, and that's what the Fed really looks at, and that index is meaningfully looser, not just from December. Some have argued that it's about the real yield curve. But the real yield curve is actually dropped in yield since December as well. So if he was so concerned in December about financial conditions, and the Chicago National Financial Conditions Index has been falling really meaningfully since the end of third quarter, beginning of fourth quarter last year, then how did things get so much better in January when every indication says financial conditions have meaningfully loosened since the fire and brimstone Jackson Hole speech, since QT started, since the first rate hike? That's a question I want to leave you all with tonight. Be sure to check out my article on exactly this. I talk about what I am thinking about and what may have spooked Powell and the rest of the FOMC in an article you can find on MacroVisor.com. So until next time, I hope everyone has a great rest of their trading week. I will catch you on YouTube this weekend for my Mayhem in the Markets. Otherwise, wishing you a great Friday ahead and an awesome weekend. I'll catch you soon.